Welcome to the Great Reset Opportunity Report. I'm Chris Blasi. Our guest today is Michael Pento. A lot of you are probably very familiar with Michael because he's been a fixture in the financial world as a commentator on many of the channels and outlets for many years. Michael's primary focus is that of a wealth manager, and he does that through his firm, which he founded and is currently the president of, Pento Portfolio Strategies. Michael's also been an author on things about macroeconomics and finance. So I'm happy to have him on the show today. Michael, welcome to the show.
Thanks for having me on, Chris. I'm looking forward to the interview.
That's great. You know, you've had some really good interviews recently and been talking about some very pertinent stuff relating to what's going on in the world. Now, just to back up, you know, the premise of this show is we talk and we use this term, the Great Reset. And that's not to infer that things aren't always changing. I mean, from the 60s to the 70s to the 80s, there was always change. But during that time, the institutions in place continued to grow in power and stature. The Great Reset kind of infers that some of the changes that are coming or maybe in process now will be of a greater magnitude and scope. And we like to start the show by understanding what our guest's opinion is, whether they believe there's going to be change of a greater magnitude and scope than in the not so distant past. And if so, how would they define that?
Well, I do agree there's going to be a great reset. How do I define a great reset? I believe there's going to be a monumental reset in sovereign debt and in currencies. And it's not going to be decades from now. It may not even be years from now. Maybe within quarters from now. And let me explain why I just said that. So what a reset to me means is that there's going to be a default on sovereign debt. And there's going to be a default through explicit default, not implicit. Implicit means through inflation. So we're going to first, right now, and by the way, I run an inflation, deflation, and economic cycle model. I understand that the debt of the world, which sits at $250 trillion today, up 70 trillion since 2008, must be defaulted upon. And one of the ways they're going to default upon it is through inflation. But when you think about a great reset, that's going to be a deflationary restructuring. In other words, reneging. We can't pay you, default. And that's going to involve currencies as well.
So yeah, there's a lot of cross currents, and I think that confuses a lot of analysts, you know, with the inflation aspect and the deflation. And you've already touched on a lot of key things we really want to drill down on with you. I'd like to start with this, though. I know you've talked about, and you've been adamant by saying the Fed is going to pursue radical inflation. Mm-hmm. So for our listeners, how do you see them deploying that? And what is the timeline for such?
Okay, well, we already had, Chris, radical inflation for the Fed. Normally, they just tinker around the edges of the Fed funds rate, traditionally speaking. But in the wake of the Great Recession, Ben Bernanke had to do extraordinary measures, emergency measures. One of those measures was to counterfeit or print through quantitative easing about $3.8 trillion worth of mortgage-backed securities and treasury bond purchases. So that's extraordinary, but he didn't do that so much to create inflation and bail out the consumer. He did so to bail out banks. Remember, he pays banks interest on excess reserves.
The Fed serves the banks.
So they don't lend that money out. So they keep it there. So they take a bank's bad assets that could bring them under, cause them to be insolvent, take them off their balance sheet at any price. It's a very small haircut below par, as a matter of fact. And then they give them credit, which is really cash. Fed credit is the same as cash. So they bailed out the banking system. That really didn't bail out the consumer. But the next turn of the inflationary cycle, we're right now, my model is predicted for several quarters now, that we're headed for a deflationary crash in the short term. But coming out of that debacle, they're going to have even more extraordinary measures to deploy. And like I'm on record saying this, that they're going to have to use negative interest rates, the banishment of cash, and the direct monetization of treasury debt. Rather than going through the primary dealers in the banking system, actually monetize, directly print money and send it to the treasury. Treasury borrows that money from the Federal Reserve and sends it to checks in your mailbox, like things like universal basic income. That's what's going to happen. I just want to touch on one point, because I come on shows like this and I can actually expound upon my theories rather than give you a silly soundbite, a fatuous soundbite on CNBC, which you look at a chart and you say, oh, looks like we're going to bottom here. Yeah. That's not what you need anymore as an investor. So I was talking about the Great Reset and all the debt that we have outstanding, which is now about just below $250 trillion, about 330% of global GDP. World record, incredible amount of debt that has to be defaulted upon. And let's just take the United States, for example. The United States, here's the problem with the debt, and this includes the United States. We have $22 trillion national debt. And for the most part, the Federal Reserve was buying U.S. Treasury debt. We had the ECB buying Greek debt and Italian debt and German debt, French debt, Portugal, Spain, Etel. And we had Japan, the Bank of Japan, buying Japanese debt. Well, here's the problem. We have all of this debt that's outstanding, and it's grown exponentially since 2008. And the only reason why things didn't fall apart is because central bankers were printing $14 trillion. They printed so far about $14 trillion to make sure interest rates were actually falling as the debt increased. And what they have done, what they have created, is the biggest and greatest distortion in asset prices the world has ever known, which is a global bond bubble. That, my friend, is a fact. That is not my opinion. Can I give you some data? The German 10-year bond yields 0.27%. Now, Chris, that is hundreds of basis points below the average, even though Germany has a ton of debt outstanding. And I can go through all the countries. I can tell you that the Japanese 10-year note is basically zero. The US 10-year note is under 3%. The average is well over 6%, going back out after 1971. So you have record debt sitting on top of a bond bubble. So the only thing that keeps this whole thing together from resetting and collapsing is low interest rates. So what's happening now is that central banks have stepped away from increasing their balance sheet on a global net basis. They were printing $180 billion each month at the high in 2016, 2017. Now they're at zero. In fact, the ECB mentioned late last year, late in December, that they were going to stop buying bonds, new bonds. They were going to stop increasing their balance sheet. So let's take it to the United States. The U.S. Federal Reserve has about $2.2 trillion in treasury bonds. And the increase, what I find fascinating here, is that the increase in the publicly traded debt soared by $10 trillion since 2008. So that relatively small size of $2.2 trillion treasury bonds, which they're mostly being rolled over, although they're selling $600 billion of mortgage-backed securities and treasuries in fiscal 2019. So that small amount of treasuries they're rolling over is trying to support the increase in $10 trillion. The total amount of publicly traded debt now is $16 trillion. We have $22 trillion national debt, but we have intergovernmental debt held by the entitlement programs. So what I'm saying is interest rates have to rise, and if they rise, they bankrupt the countries. Mm-hmm. But if they don't rise, the only reason why they will not rise is because we're already in a global recession/depression. That's the truth.
You obviously do your homework, and I know your data is solid. it's correct. I think your model is very interesting, and I believe it's very valid, the deflation inflation. So, you know, an expert.
I smell a butt coming.
No,
No, okay, good.
no. Actually, what I'm going to say is, you know, the listeners, you know, shows like this, what people are looking for, right? You're the expert. You take in all this data, you distill it down, and you help to give them direction. So I just want to go over a couple major asset categories with you,
Sure.
which typical listeners would have a position in. And based on your models, what do you see playing out? And it sounds like I heard you before. It's these conversations, and I've heard you through the years, and you know, a lot of my guests that you're familiar with, these have been people who spotted this coming a decade plus ago. Now it looks like it's all playing out. I mean, you made the comment, and I agree that this could be this is only quarters away. Now, going to specific asset classes, in the upcoming model of yours, obviously the biggest one for the average person, let's talk about equities. What do you see happening with U.S. equities?
Okay, well, first of all, maybe I should have clarified that when I said the reset's going to happen in quarters from now, but we're already in the middle of this calamity. There's no doubt. I mean, if you look around the world, if you look at the price of commodities, if you look at what's happening in countries such as Mexico and Canada and what's happening in Europe, Germany.
Just to level set, Mike, I'm on board with you. This reset's already underway. It's really it's an acceleration.
I'm not familiar with your audience,
Sure.
but they should know that Germany is contracting in GDP. Japan is contracting in GDP. China is really, if you look at auto sales, they're contracting, not growing 6.5% as they make. Communist nation makes up numbers.
Sure.
They're contracting. So you have problems in the Asian bloc. You have problems in South America. You have problems in Europe. You have problems here in the United States. So you asked me about equity. So I have a 5-sector spectrum, which is derived from a 20-point inflation-deflation economic cycle model. So right now the model says we're going into we're in sector 2 and then going into sector 1. So we're kind of right in the middle between sectors 1 and 2. What do you want to own in sectors 1 and 2, which is a deflationary, disinflationary recession / all the way in sector 1 is a depression, a la in the manner of 2008. So you want to avoid high beta names. You want to avoid the FANG stocks. You want to avoid Netflix, Google, Amazon, all the things that worked in spades in 2016, 2017. Indeed, for the last several years, but went on steroids in 2017 and up until January 2018. You want to avoid them. What do you want to own? You want to own bond and bond proxies. Now, this might sound very strange coming from someone who wrote a book called The Coming Bond Market Collapse. But when you enter into a deflationary cycle, you want to own bond and bond proxies. Well, I have mostly been in utilities, which have been very, very well in our model portfolio. I was shorting European stocks and market stocks a while back. I've been long the dollar for several quarters. So these are things that you wouldn't expect to hear from somebody like me usually, but I have a model and I follow the model. This is rigorously back tested. So you don't want to always say to people, one day gold's going to skyrocket and one day China is going to take over the world. So just short the dollar and buy gold, you'll be fine. Well, I actually agree with that, but you got, what's your value there? Your timing has to be better than that because you could bankrupt people while they wait. So yes, we own utilities. Like I said, we are long the dollar, and we are at various times in the past few weeks been short the market with pretty good success.
Okay, that's equities. You talked about the bond market, your 2013 book, right? That was about the bond market. So can you expand a little bit more on what you see playing out over the next seveul years in fixed income?
Well, what I see is what we just talked about in the wake of the next recession, which is going to be brutal in my opinion, because the central banks just don't have the tools that they once had. I mean, the European Central Bank, as I said, just stopped QE late last year. but they haven't raised rates. They haven't even started, draining their balance sheet, Chris. So the ECB cannot cut interest rates at all to engender a recovery. And the same goes for Japan. Japan is at a negative discount rate, and they haven't really stopped much of their QE at all. And the Fed only has about 250 basis points to reduce borrowing costs. So they're kind of going to be strained when they go into that next iteration of quantitative easing. They're going to have to start to find new ways to get that inflation going. And like I said, that's going to circumvent the banking system. That's going to be very, very pernicious to any type of fixed income proxy that you can think of. Because I think we're going to have a bout of stagflation in 2019 like we haven't seen since the 70s. It could be even worse, Chris. It could potentially be worse than the 70s. So anything that a central bank isn't actively buying, any fixed income instrument that the Federal Reserve isn't actually buying, is a massive short. And in all disclosure, in the model portfolio, we are short high yield because I think that blows up in a huge way this year.
Sure. Now, you talked about precious metals, and I know you've been you focused on that for years. A couple things came to mind. You talked about a deflation, and I want to get your opinion on the position that in a deflationary period, the price of gold, the other precious metals can go down, but their decline relative to the rate of deflation, that they would still be, from a purchasing power perspective, still it would be a sound investment. You have an opinion on that theory?
Listen, like I said, I have a model that's been rigorously backtested. You do not want to own gold when the dollar is rising and real interest rates are rising. And that's exactly where we have been in the recent past. So we're very much underweight gold, even though I consider myself a gold bug. It's the only real and honest money out there. But when do you want to own gold? You want to own gold when the dollar is falling and real interest rates are falling. And I think that's going to be prevalent throughout this year. And so I'm slowly building my position in precious metals, but it's not yet time to overweight that in the portfolio. I want to hear something from Jerome Powell saying that the Federal Reserve isn't just going to no longer hike interest rates, but is now have a bias to reduce interest rates and a proclivity to go back into quantitative easing. That would get me very, very interested in overweighting gold. But
okay.
As of now, the answer is no.
So basically,
Chris, the honest answer is that my only motivation is to make my clients money. I don't have any other agenda. That's the reason why you get an honest answer from me. However, I will hasten to add that when that dynamic changes, when the dollar starts to weaken, as all fiat currencies are going to weaken in this year, in my opinion, against precious metals, and when I see the nominal level of interest rates fall, and I see central banks gaining traction as far as increasing the rate of inflation, which means real interest rates will be plunging. Well, you're going to see a rally in gold like we have never seen before, in my opinion, ever.
So it's safe to say that for those investors at least are starting to get in the precious metals market, right? Maybe building their positions. That's still the timing isn't, as you said, right to go overweight, but it's not imprudent to start to build that position now for some folks.
Exactly, Chris. And I just want to add that, one of the reasons why gold was almost $2,000 an ounce, because deficits were soaring. There was like QE to infinity, and there really wasn't a clear understanding as to where this was all headed. I mean, we weren't really sure if deficits would ever come down again, not only in nominal terms, but in terms of in a percentage of GDP. We weren't really sure. Here's the watershed change I think is going to happen this year, is that I think central banks are going to have to admit that everything they've purchased can never be unwound. And that's really significant. In other words, they have permanently monetized all of the assets that are on their balance sheets. And that means that interest rates really can never be allowed to rise. They're gonna go into some semi-permanent that was gonna last. I mean, last for years in their various iterations of quantitative easing across the globe. People will know, investors will understand that Japan never got above zero. The ECB never got above zero. The Fed never got really anywhere close to 3%, and the economy fell apart. So when is the next time that gold investors are going to have to worrying about the carrying costs involving the lost opportunity costs of owning gold? Never. Maybe not for years and years will we ever have to worry about a central bank saying, hey, we're going to end QE and we're going to raise interest rates. In other words, real interest rates will probably be negative for a much longer time than they were in the wake of the last recession, which is like rocket fuel for precious metals.
So let me ask you one other thing then about the central bank. At the end of these events, does the Fed still exist? Will it be replaced by another central bank?
Well, you're getting out of
it's speculation, but people
speculation. It's hard to model this, but not that I don't think about it, but if central banks lose control of fiat currencies, and part of that great reset that we talked about before might involve the IMF and a mass change of currencies from fiat to some kind of cryptic, a global cryptocurrency, an IMF coin or a Fed coin. This is all theory and conjecture on my part. It's hard for me to imagine that only one nation, like nation of Japan or maybe Europe, could default on its debt and everybody else be fine. So they might have some kind of coordinated default on the debt. Everybody gets a certain cents on the dollar, and you have a new currency that's backed by the full faith and credit of the IMF, as if that's any better. They have special drawing rights, the IMF, so maybe it would be a cryptocurrency that's backed by the special drawing rights. My hope is, that's my fear, because that's not going to end any better. My hope is that we go back to backing currency and specie, precious metals, gold. This way, why do I say that? Because if the mine supply of gold increases about 1.5% a year, it's kind of commensurate with population growth, productivity growth. You don't have any of these. You keep that base money sort of fettered and chained to a very slow rate of growth. It's very hard to get asset bubbles the way we have today. That's my hope. That's what my hope. Do I think it's going to happen? Again, that's my hope.
Well, just to say, gold is very fascinating in the sense there's so much about its characteristics that really do make it ideal money. From again, how much comes out of the ground, managing growth. It's really unmatched. Now, Chris,
it has intrinsic value. It costs about about $1,200 an ounce just to get it out of the ground. That's the energy involved in getting it out of the ground. Then it's, of course, extremely beautiful, it's very rare, and virtually indestructible. How many elements? This is what this is why I don't get about the Bitcoin people. They don't like me very much, but I don't care. I was wrong on the way up. I didn't like Bitcoin when it was $2,000-$3,000. I hate it when it was 19,000 a unit, and I still hate it when it's 3,000 a unit. You can create many cryptocurrencies basically by decree in a matter of hours. They all serve the same function. It's a way of anonymously, immutably moving money throughout the globe outside the banking system. Although now they wanted to regulate it, but you could fork. Bitcoin also forks, and there's more Bitcoin. It's like a commodity. It serves the same function. But as far as I know, we're not discovering any new elements that are very rare and virtually indestructible. That's the key. And that's why gold is so. It was money for thousands of years. It will be money for thousands of years, and Bitcoin will not.
Well, we could go on and we can't do it because it's such a big topic, the whole cryptocurrency Bitcoin thing. And
Yeah.
I think we share some, very similar opinions. One thing is, because you said it, even the idea, like you talk about gold, it costs X amount to come out of the ground. So that naturally puts a
Energy.
value to it.
Yeah, it's a real energy.
Yeah, Bitcoin, to me, it's a totally contrived thing. The Bitcoin mining, the amount of, but that's contrived. It's not natural. And, as you talked about the fork, people that believe things in the internet, that it's transacted in the internet, that somehow it's a mystical world out there without the problems of any technology related item. And, the Bitcoin uses the blockchain, which is nothing but a glorified database, maybe a sophisticated database. And it proved out when it forked and needed an upgrade. And no one asked the simple questions. Who did the upgrade? How did people, if you can do an upgrade, you access to
did every Bitcoin holder vote for this fork?
Exactly.
Who's in charge of deciding how many times this thing, they say fork because it's a euphemism, sublimates the fact that they're really doing, which is they're diluting the current, they're diluting it. They're diluting it because it still serves the same basic function, right?
Yep. You talk about not backed by the full faith. Bitcoin is backed by faith in no one knows who. At least in a national currency, you can see a standing army. There's something physical you can see.
Taxation authority, the U.S., the might of the military. There's really, listen, I know I'm right. People will argue with me incessantly that I'm wrong, but it's not a very good currency. You can't even really do a lot of transactions because the bandwidth isn't there yet. Maybe someday it will be, but it's just not right there. So it's not a good currency, and it will never be money. So maybe eventually it's sub $100 a unit, and you can transact on the dark web. Because the government, the whole thing is that they wanted this thing to be decentralized, right? It's immutable, it's decentralized, and it's anonymous. That's why they're all a commodity. But then they say, but then we can regulate it. Well, if you can regulate it, then how is it decentralized? And if it's not decentralized, then what good is it? What actually is it? I don't understand it. I don't get it.
It's actually still trying to.
Chris, it's not just me that doesn't get it, and that doesn't get it. The market doesn't get it because it went from 19,000 to 3,000, so it's not really a very good store of value either.
Well, that's exactly it. It's trying to figure out what it is. When it said, people are buying it because they thought, we know there was a guy claiming it was going to 1 million. And if you're a business, you can't use it as a medium of exchange with wild price fluctuations. So you can't be both. You can't be a speculative asset and money at the same time. And so Bitcoin couldn't figure it out. Unfortunately, most of the people who were promoting it and touting it, wouldn't answer that. And right now, the people who are skeptical about it have been right. Now, I don't think cryptocurrency or digital currency is disappearing. It'll probably manifest itself and maybe nationally issued, right, by sovereigns.
Well, that's what we talked about, yeah.
But we'll say, just like any technology, this first, the 1.0 version, which is what Bitcoin was, and a lot of these other ones, Litecoin, they probably won't be around, and they'll be replaced. But that's a topic that is fascinating, and we could really go on. I'm going to wrap up with one question, and this is more on anecdotal, and see if you kind of share our opinion. Because the Great Reset is truly global in scope. Would you concur that what we see going on in the world, the trade wars, the pushback on the establishment in the European Union, in Italy, in France, in Europe, would you agree this is truly all connected? And this is really, that these are correlated together, and this is all part and signs that your forecast and the forecasts of others that see this reset are on track and correct?
Well, it's all part of the same undercurrent symptom. Basically, it's the financialization of the world. So people like me work on Wall Street, doing very well. People work in the banking financial industry, doing very well. People who used to have a job as a manufacturer with a great pension and great income, great healthcare plan, those people have been moved to Uber drivers and Walmart greeters. So there's been a hollowing out of the middle class globally because of this incessant view that we have to, screw savers for the benefit of banks and Wall Street. This is exactly what's happened. So you took interest rates to 0%, left them there for a decade. So savers got, I'll use that word only once, okay? So they ended up earning nothing for saving money. The people that were involved in the world of finance made a lot of money. People who own assets, the very richest of us, we had our houses and our bank accounts, our stock accounts go higher. And those who were relying on a good paying job got moved into the lower class. So when you hollow out the middle class, which is always throughout history is the backbone of a strong nation, and you take them and you flush them down the toilet, you get civil unrest. This is what happens. And I've seen people are voting now just to throw a grenade into the system. They just want to blow everything up.
Absolutely.
So that's why you have people come into power who are, throughout history, that's how you see autocrats and megalomaniacs take power. And it's not a good trend. You want the foundation of any strong nation is a solid middle class. And that is exactly what central banks have hollowed out. Because they decided sometime a while back, they decided that because of their hubris and arrogance that they can repeal the business cycle. And somehow the stock market can never go down more than 10%, and we can never have a recession. Recessions are very cathartic, very cleansing. They purge out the system of malinvestments. And now we were faced not too long ago, late last year, where the total market cap of GDP was 150%, 1.5 times the economy. That has never happened before, even in 2000, which was when it peaked beforehand. So asset prices have to fall, debt levels have to contract, and that's all part of the Great Reset, which is coming. And the Great Reset should be, prayerfully, a healthy phenomenon.
I agree. It's going to be cleansing. We can move on to something better. It'll be painful, but like a medical analogy, sometimes you have a condition that requires some pain and rehabilitation, but for much better in the future. So, Mike, I want to thank you for a great conversation. You really shared a lot of great information and perspectives with our listeners. So tell us a little bit about where people can go to learn more about you, about Pento portfolio strategies and the services that you offer.
So I manage money, part of the things I do here. The website is pentoport.com, pentoport.com. My email address is mpento@pentoport.com. You can call the office here at 732-772-9500. Once again, you're not going to be a passively managed pigeon if you come here. I run this like a hedge fund without hardly any of those fees. I just charge 1.5% on assets under management. I don't charge 2 and 20, no performance fees. And in that matter, I can best take care of my clients who really deserve to be treated fairly in this world. You cannot go to a wirehouse when they tell you, let's just buy and hold and dollar cost average. It's not going to work. The market is probably going to have its third 50% drawdown since the year 2000. And I run an actively managed portfolio based upon that 20-point model, which allows me to short the market, allows me to go long the dollar, short the dollar, buy precious metals at the right time. So you come here, I'll treat you well, and I think you'll be very pleased.
Well, that's great, Michael. Hey, I hope, again, later on in the year, maybe a few months down the road, we could reconnect because things are moving fast and unfolding, and we'd really appreciate, getting your insight down the road. So I want to thank you again for coming on the show.
It'd be my pleasure, Chris. Thank you.
Take care.